Treasury Scott Bessent, Treasury Secretary, obviously, he was telling Bloomberg this week that rates should be 150 to 175 basis points lower, warning that Powell risks staying too tight for too long, which, I mean, you've talked about this, but let's take a listen to that clip.
What if the BLS data had been the higher quality and we'd had those numbers, Jonathan? So if we'd seen those numbers in May, in June, I suspect we could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut. And I think President Trump is very good at giving these nicknames. And I think the reason that the Jay Powell gets the nickname too late is because he wants to go into a series of rate hikes. He's not Alan Greenspan, who was very forward thinking. They try to be more data driven, which I think is a mistake, because I think we are going back into an economy like we had in the 90s. So, it's just very old fashioned thinking, but I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September.
I mean, Danielle, he's arguing that this isn't really about weakness. It's about avoiding unnecessary damage from over tight policy. Does that reasoning hold up in your view, Danielle? I mean, if the Fed cut by 50 basis points in September, would the inflation risk outweigh the growth benefit?
So, it's very hard to say. I understand where Treasury Secretary Bessent is coming from. Obviously, had we had the May and the June data that was revised materially lower before that July meeting, we probably would have seen that first 25 basis point rate cut at the July 30th meeting. So I see where he's coming from, but rate cuts to me, and I was only on the inside for 9 years, so what do I know? But rate cuts typically accompany slowdowns in the economy.
Yeah. And I was watching the tape when you joined us back in June, the last time you were on the show. You said that the private sector was already somewhat in a recession even before the data confirmed it. Now, with wholesale inflation up, we got continuing jobless claims near multi-year highs and then delinquencies rising. I mean, do you see that call being validated?
Well, certainly. And we've also had another large revision to the payrolls data that validates the fact that net job destruction began in the second quarter of 2024. There's a certain irony in terms of how market participants are treating this big shock downward revision in July. But when you add it all up, 24 of the last 30 months have seen downward revisions from what was originally reported by the Bureau of Labor Statistics. So this is nothing new. And we are indeed seeing the vestiges of this. You mentioned delinquency rates, whether it be credit cards, and now we're going to pile on the effect of having to repay these student loans. So, I don't think that the last chapter has been written in terms of distress on U.S. household bank sheets.
Yeah, these initial jobless claims dipped kind of last week, but the continued claims remained elevated. Which tells the truer story?
So remember, an initial jobless claim is exactly as it sounds. Right. You can apply for jobless benefits. You can apply for unemployment benefits. Will you get approved for them? Mm-hmm. In many cases, the answer is no. States spent an extraordinary amount of money in the aftermath of the pandemic hitting the U.S. economy, and states are much more reluctant to approve a jobless claimant, and that is why we look much more at the continuing jobless claims, people who have gotten through the process and are receiving continuing jobless claims, as being the truer indication of the state of the economy, to say nothing of the fact that we have millions upon millions of gig workers and individuals working multiple jobs part-time for economic reasons. They're doing this because they can't get jobless benefits.
Right. Yeah. And you talked briefly about those student loan delinquencies. I mean, they're above 10%. Credit card delinquencies near decade highs. It doesn't really fit the strong labor market narrative. But I guess my question is, if full-time employment is slipping, participation is flat, is this already a jobs-led slowdown?
Oh, that is typically what we come to know. Yeah. People talk all the time about the non-farm payroll survey response rates being as low as they are. But for heaven's sake, the unemployment rate, the sister survey that creates the unemployment rate also has very low survey response rates. And I think that that's one of the reasons when you look historically and plot out the data, that the unemployment rate seems to be out of step with the very high levels of distress that we're seeing on household balance sheets. Something is incorrect here. One of the two is not correct, and I think we're discovering that. And we had a subprime auto lender last week just pull the plug, just say we're no longer in the business of making car loans, which means we're no longer in business.
Yeah, I got to ask you about the data quality because, of course, we just heard Bessent talk a little bit about that data dependence. You know, we had these CPI mythology changes. We had this discontinued kind of PPI series. And then, of course, these big revisions to those past employment data. How much does that complicate the Fed's decision making here? I mean, we got a new guy in the BLS.
Yeah, so it remains to be seen. I certainly think, and I've been saying this for months, that we need to revisit how these data are compiled and reported to the public. They're extremely important. You know, this is not China where you just say, okay, take it with a grain of salt. That's certainly not the standard that we should have in the United States. I do think we need to look at how to better align actual company headcounts with what's reported to the public. And I suspect that this quarterly census of employment and wages is pretty simple for the head of human resources to report on a quarterly basis to the Census Bureau, and that is then provided to the Bureau of Labor Statistics. Why don't we ask companies once a month what their headcount is and just go straight to the source?
Yeah, E.J. Antony's been on this show. I'd be curious to see what he does there. You've been in the rooms, you know, you've advised the Fed. When data contradicts the policy narrative inside the Fed, do those concerns get a real hearing or does consensus override them?
I certainly think that right now that consensus has been a force.
Yeah.
On the other hand, prior to Michelle Bowman dissenting, we hadn't seen a dissent since 1995. So it's apparent in the fact that there is greater frequency among Federal Reserve Board members, that there's greater frequency and even a higher number. We had 2 dissents, that there is definitely disagreement on the Federal Open Market Committee. And in fact, we've seen that accelerate and grow in numbers such that if you play it out, you could possibly see 6 dissents at the September meeting.
Yeah, that's never been, I don't think, has that ever happened?
Actually, prior to the transcripts being provided to the public, Paul Volcker, infamously, for people who follow Fed history, had mutiny in 1987 on his Federal Open Market Committee. There is precedent to this, but it would really rattle markets, I think, to reveal that kind of that level of disagreement among the 12 voting members, if we do indeed get the nominee confirmed by the Senate prior to the Fed meeting on September the 16th and 17th.
There's been a lot of names being floated around. I mean, even in that Bloomberg interview with Bessent, he was being a little tight-lipped. I think he said something about he's looking at a wide net of 11 people for potentially to take over Powell. Who are you hearing about?
You know, I think that the market's money was on Kevin Hassett being named to replace Governor Adriana Kugler after she left. I think the markets were surprised that that was not the route taken. And now that Bessent has cast such a wide net all the way out to Wall Street strategists, it's very difficult to see what the thinking is. And you have to bear in mind, there is reputational risk for a true academic type of economist if you're being publicly nominated to come in as an effective puppet. And with the administration and the Treasury Department being your puppet masters. So maybe it's more difficult to fill the position than it was because of how it's being cast as controlled monetary policy from others, which is the opposite of independence.